All right, let's dive into WD-40's latest earnings. This one's a real head-scratcher. You've got management on the earnings calls sounding super confident, painting this rosy picture. And then you have the market, which basically ran for the hills. So what's going on here? We're going to get to the bottom of it.
And I mean ran for the hills. Look at this, down 9.5%. That's the instant after-hours reaction. So right out of the gate, despite everything the company was saying, the stock just got hammered. And that sharp drop is really the whole story we need to unpack here. So you've got two completely different stories, right? Management is telling you everything's strong. The market is screaming that something's weak. Who's right? Is the market overreacting? Or did management miss something big? Let's dig into the actual numbers and see which story holds up. Okay, so let's start with what the market saw first. And honestly, it wasn't pretty. The company missed pretty much across the board. You look at earnings per share, they came in at $1.28. The street was expecting $1.45. That's a big miss. Revenue, basically flat, and also a miss. EBITDA, same story. So from the get-go, every single headline number that flashed across traders' screens spelled disappointment. No wonder they hit the sell button. But here's where it gets interesting. Despite those ugly headline numbers, management got on the call and told a completely different story, a much, much more positive one. So let's hear them out. What's their bull case? Okay, so the CEO, Steve Brass, he gets on the call and says, hold on, everyone, this isn't a demand problem. His big point was that in their direct markets, where they sell right to the big retailers, sales were actually up a healthy 8%. He's essentially saying the real issue was just some weird timing with their smaller distributors, and that's all going to bounce back later this year. So according to him, it's a hiccup, not a crisis. And this was the crown jewel of their argument. Gross margin expanded by 140 basis points. For you, that just means for every dollar of stuff they sold, they kept 1.4 cents more than they did last year. That's a huge deal. It tells you they're controlling costs, they have pricing power, and operationally, they're running the business really, really well. And trust me, they talked about this a lot on the call. And it wasn't just the margins. They had other bright spots to point to. Their specialist product line, that's their higher growth stuff, was up a massive 18%. E-commerce sales up 22%. And then look at what they're doing with their cash. They're buying back more of their own stock, and they just hiked the dividend by 8%. You just don't do those things if you're panicking about the future. That's a sign of real confidence. Okay, so you hear all that, and you're probably thinking strong direct sales, killer margins, share buybacks. So why the heck did the stock drop 10%? Well, now we pivot to the market side of the story, because investors, they looked straight past all those positives and zoomed in on something else. And here's the rub. Remember that awesome margin expansion we just talked about? Well, it didn't make it down to the bottom line. They missed earnings by 17 cents. That is a huge miss that investors just couldn't stomach. It pretty much screams that even though they were making more on each can they sold, other costs in the business exploded and ate up all those gains, and then some. So this slide really lays it all out, right? The two competing stories. The narrative from management is, hey, it's just a timing issue with our distributors, don't worry. But the numbers tell a different story. Flat revenue. Operating income actually down 7% from last year, and you can bet the market looked at that and thought, are we sure this is just a timing issue? All right, so the past quarter was complicated, but what really matters for investors is what happens next. So let's put their guidance for the rest of the year under the microscope and see what they're telling us about the future. So they kept their full-year guidance the same, which on the surface seems fine. They're still expecting decent sales growth and really strong margins. But, and this is a really important but, if you look at the middle of their revenue forecast, it's actually about 1% lower than what the street was already modeling. It's a subtle signal, but it's one of those things that makes investors nervous. It's like they're saying, yeah, we'll hit our numbers, but maybe not the way you were hoping. And to make things even more complicated, there's this big strategic move happening in the background. They're basically selling off some of their other brands, the home care and cleaning stuff, so they can focus 100% on the classic WD-40 products. Now, long-term, that's probably a great move. It simplifies everything. But for this year, it's a headwind. It means about $12.5 million in sales and 20 cents of earnings just disappear from the books. Okay, so let's put all the pieces together. We've got the good, the bad, and the complicated. What does this mean for the stock going forward? Let's build out a thesis and figure out what to watch for. If you're watching this stock, here's your checklist for the next few months. Number 1, that brand sale. Any news on the timing or the price is going to move the stock. Number 2, those amazing gross margins.
Was this a one-time thing, or can they keep it up? 3. The Asia recovery. They promised a big rebound there, so we need to see it happen. And finally, they talked a big game about hitting the mid to high end of their guidance. Okay, now they've got to prove it.
So, what's my take? I think the stock is probably stuck in the mud for a little while. It's going to be range-bound. You've got this tug of war between the great margins on one side and the big questions about execution on the other. Until one of those catalysts we just mentioned gives us a clear signal, I don't see it breaking out in either direction.
And that leads us to our official rating here, market perform. It's really the only thing that makes sense. You can't ignore the power of the brand or those incredible margins. But you also can't ignore the fact that they missed this quarter, the guidance is a little soft, and there's this divestiture hanging out there. It's a perfectly balanced wait and see situation. But wait and see doesn't mean there isn't a trade. In fact, this setup is pretty juicy. You've got management's confidence clashing with the market's skepticism. That kind of tension often leads to a big move, a breakout. The question is, which way? So a plausible idea here could be something like a long-dated option straddle. The logic is simple. You're not betting on direction, you're betting on volatility. If management is right and they knock the next quarter out of the park, the stock could soar. If they're wrong and they miss again, it could tank. Either way, a big move could happen, and that's what a straddle is designed to capture.
And of course, we have to say it. This is not financial advice. Please do your own research. We're just giving you a framework for how to think about what's going on with WD-40 right now.